Okay, so Taylor, remember just last year he came in, we filed his first tax return, we got him to put into a Roth IRA, and then we advised him on 401k. And now we should advise him on something else, additional things. Now, know that for employees who get W-2, they're very limited on deductions, really. Really, the things that they have the most is going to be 401k. That's going to be probably the best tax saving vehicle that they're going to have. And then second is little things that we could try to add up together for being an employee, and it's called cafeteria plans. Cafeteria plans are little perks that the employer will give to its employees. So the boss will give to its employees. So you have the 401k, that's a perk, that's a big perk. Now let's go to the little perks as well. Talking about the details of what can they qualify for to get additional tax savings. It's not going to be big like the 401k, but still very helpful and something that everyone should take advantage of if they can. Okay. So it's a cafeteria plan, also called, I think, a 125 plan, is a benefit plan that employers may offer to their employees as a company perk. Employees get to utilize these plans and take unique advantage of the offer by saving on taxes or out-of-pocket expenses. So we know there are certain things that you could do to save on taxes, but also there are some perks where the employer will pay it for you instead of you paying it yourself, which is a big deal of trying to recruit people into the company. Okay, so the cafeteria plan offers tax savings, flexibility and choice, and then reduce out-of-pocket expenses. And we're going to go through various ones so you understand what can you recommend to a client, because not all clients are going to try to utilize everything. It's very specific to the type of situation that they're in. Okay. So there are various plans that you can pick and choose if offered, and these plans can cover yourself and possibly a spouse or even dependents. Okay. So the three major plans, it's really two, but there's going to be health benefits, so anything relating to health, which are health insurance premiums, FSAs, which is flex spending accounts, HSAs, health savings account, life insurance and disability insurance. There's dependent benefits, which is dependent care and adoption assistant, and then commuter benefits, which is like paying for bus passes or parking expenses. This is not very common. I don't really see this one too often. What I do see are these two. These two are the most: health benefits and dependent care benefits, because that's the most common, right? So we're going to go through each one in more detail. Okay. So what you'll see here is that I blocked it out so you see. Okay, if it's paid by the company, this is probably the best benefit because no money's coming out of your own pocket. You don't need to worry. The company's just paying it for their employees, right? And then there are certain ones where it requires the employee to put the money in themselves to get the tax benefit. And then sometimes there's a little bit of both. Maybe the company might pay for it, or maybe the employee has to put it in themselves. So this is for health, right? Yeah. So health-wise, health insurance premiums is probably one of the biggest ones. This is where, for health insurance, the company will pay the health insurance for the employees. So one big perk with working at a big company is that the employee doesn't have to pay for health insurance. The boss pays for it all, and they're covered usually for themselves, their spouse, and their kids as well. So it's a big, because health insurance premiums is very expensive, especially in the United States. Very expensive. So if the company is willing to pay for it for the employee, then that's like a perfect thing to really take advantage of. Okay, so most people automatically enroll in this. So this is usually automatic. Okay, the next one, health FSAs. What this is that it's a special plan that the employee, out of their paycheck, they'll say, okay, I'm willing to put, let's just say $2,000 throughout the whole year into this special account called an FSA. It's called a flex spending account. And the company will slowly deduct it out of their paycheck, whatever amount they select. And what they could use first off, the amount that they put into this FSA account is tax deductible. So meaning that it reduces their taxable income. So if they make $100,000, they put $2,000 into FSA. Now their taxable amount is $98,000, right? So it's a little way to just reduce the income a little bit more. And in this account, as the money is in there, the person could take money out of that account to pay for health costs. So if they go for doctor visits, dental visit, or even if their kids have to go to the doctor, get glasses, you could use the FSA to pay for that. So a lot of times people will put money into an FSA and then they'll use it throughout the year, but usually at the very end of the year is when they start buying like glasses and stuff, because that's easy to write off. And the reason why at the end of the year they spend all that money, because it's called a use it or lose it plan. Meaning that if you put money into the account, you have to pretty much spend it all. If you don't spend it all, you're gonna lose it, okay? So if you put $5,000 to an FSA account and you only spend $2,000 and there's $3,000 left over, then you could potentially lose a lot of it, okay? There are certain rules that allows for it to roll over, like $500. I think that's the max, but pretty much everyone tries to spend it by December 31st. That's the rule. Yeah, they have to spend it. So, and this is really good for people who know they have health expenses that they're going to pay throughout the year. So maybe if they have a bad back, they go visit chiropractors or something like that, they could use that to help pay for it. They wear glasses and they know they're going to buy glasses every single year, then this is usually a good plan to have. Okay. The next one is health savings account. Now this is similar to an FSA account that we just talked about, but it's way better, way better, because you don't lose it. It belongs to you. So the money you put into an HSA account, that money stays with you. So even if you left the company or you don't spend any of it, that money stays with you. So you could use it 5 years from now on any medical expenses, okay? And we'll go over HSA a little bit in more details, but HSA is like one of my favorite plans that I recommend to clients. It's probably the best tax plan out there, because you know how we talked about traditional, Roth, and traditional and Roth? Traditional, it's tax deduction now, you don't pay taxes on growth, but then you pay taxes later. And then with the Roth is, you don't get a tax deduction now, but then you get the tax savings at the very end. So with a health savings account, I call it the trifecta tax benefit, because you get the tax savings when you put the money into the account, and then it's actually an investment account as well, so it could grow tax-free. And then if you ever take that money out, it's not taxable as long as you use it for health. And because health is going to be the second highest expense you're going to be paying throughout your life, you're going to be using this account later in life anyways, whether you use it now or you use it later, right? So because of that benefit, the trifecta benefit, it's something that we should always recommend to clients if they qualify, okay? And it takes a certain type of account to qualify for health savings account, and we'll talk about that a little later. The next one is life insurance. This one's usually automatically given to employees as well as a perk. So pretty much if an employee happens to pass away, they are given, the surviving spouse gets $50,000 from life insurance proceeds. Okay, so this one's paid by the company itself. The next one is, disability insurance. That's part of health as well. Disability insurance is if someone gets hurt on the job, then there's going to be a payment to help subsidize the income that you're missing from missing work because you got hurt on the job. Okay. Dependent care FSA. This is probably maybe the second or third most common one that I see. This is where you use it to pay for daycare. So here, most of the time people are going to put the money in themselves. So just like an FSA, but this one's called for dependent care. So it's a separate one from FSA, from health. And they put money in there, and then as they pay for daycare, they just take the money back out to pay for the daycare for their kids. And very common for this one to be used because so many of our clients are dual income, meaning that the husband works and the spouse works. So that only gets qualified if both spouses work or they're filing as head of household. Okay, so if they're married and one spouse doesn't work and the other spouse does work, they won't qualify for this. Okay, because the government wants to incentivize people to work to make money. Okay, so they're not going to give that incentive if one person's not working, because they're able to take care of the kids alone anyway. So that's why with dependent care, we guys got to make sure that clients understand that if they're married, both spouses have to work. Adoption assistance, out of like the 1,000 clients I have, I've only seen this once. So it's very rare because adopting a kid in the United States is very expensive. You have to go through a whole tedious process to pay for lawyers, pay for travel, because most of the times when they adopt a kid, it could be somewhere out of the country. So to bring that kid over, it costs a lot of money. So sometimes companies will pay for adoption assistance. And then transit parking, this is like up to, I think, $300 a month, where if they take public transportation or they have parking fees for parking at the garage that they work at, the company the employee will contribute to it, and the company, and you get a tax deduction for it. Okay? So this is very rare. I don't see that very often. Okay, so let's go through the steps, because I taught you all the nuances and the rules for each thing, but we have to be able to explain to clients how to do it. What are the steps that they need to do? Because clients could know, oh, I should use a FSA for myself, but they don't know how to do it usually. So we should be able to walk them through it, because we want to be more than just spitting out information to them and just overloading with information, but actually, how do we provide actionable steps for them to get to wherever they need to go, okay? So this is the extra service that I think we should all be doing for all of our clients, is that not only just telling them what they could do, but okay, how can we do it, okay? So step one, review the benefits during open enrollment. So open enrollment, what that means is that it usually happens between November and December. So people have to decide in November, December, what they want to utilize the following year. Okay, so in a way, they have to be more prepared. You can't just, in the middle of the year, really say, okay, now I want to do FSA. You can't really do that. So you have to decide at the end of one year for the next year, okay? So review the benefits, so making sure that, okay, what is it that the company offers, and what is it that you qualify for? And then assess your family needs and financial goals. So like, if it's a single guy, they're not going to have dependent care FSA, right? So they don't need that stuff. Choose your contribution level. So, because some of these, you have to put money into the account and it just stores inside that account for that year. The client has to see if they could actually afford it, right? And they have to elect how much they're willing to put towards it. Because if they can't really afford to max out HSA and dependent care benefits and all these other things, then it doesn't make any sense for them to really try to do it all. So we definitely have to see if they could afford to what they're comfortable with doing. And then during open enrollment, they have to submit all the forms. So there's a lot of paperwork that goes into it, making sure you send it out to the company HR department. And then we got to track usage and reimbursement. So a lot of these things like the health FSA and the dependent care FSA, a lot of times they require proof on why you're pulling this money out of the account. So you have to submit the reimbursement to the HR department. So if it's dependent care, you have to show the receipt from the daycare showing that you paid it, and then they'll reimburse you that same amount. So sometimes they have to do it every month or every quarter, but they definitely have to keep track of all this stuff to get the reimbursement. Because remember, especially with FSA, whether it's dependent care or health FSA, if they don't get that full reimbursement and they just leave it to the end of the year and it's over and January 1st happens, they lose out on whatever money is left in there. Okay, so very important. I've had clients that forgot that they had dependent FSA, and for some reason they contributed into it and they just totally forgot about getting reimbursement, and they just lost $5,000. Right, so it sucks. Like, they had good intentions, but then because they didn't take the extra steps to get that, they lost the $5,000. And then, of course, you reevaluate every year to see if you want to do it. So remember, once this November or December rolls around again, they have to decide what they want to do. They have to decide the health insurance plan. They have to decide how much they want to put into different FSAs or HSAs. We introduce this to Taylor, right? We say, okay, Taylor, you have all these things that in your cafeteria plan that you could use. And these are some of the follow-up questions that he has. So what happens to unused funds in my FSA at the end of the year? So with health FSA, So there is a grace period. So up to March 15th of the following year, you roll over up to $610. That's really it. So no matter how much is in there, the most you can roll over is $610. That lets you carry the unused portion. Otherwise, you face the use it or lose it rule. And dependent care FSA, there is no rollover or grace period, so you definitely have to get that reimbursement for daycare services by the end of the year, or you forfeit the remaining balance. Okay? Now, Taylor also asked, hey, can I change my cafeteria plan election mid-year? And you remember, so you have to make your decision in November, December for the following year, but there are certain rules called life events that will allow you to change it in the middle of the year. Best example is someone have a kid in the middle of the year. Then they could say, hey, I have a life event. Can I now contribute to a dependent care FSA? Okay. Then there's other things like marriage and divorce. I'm not sure how that would apply, but pretty much the most common one is just having a kid. Okay. And then open enrollment we talked about is the end of the year. Okay. What documentations do I need to keep for the cafeteria plan reimbursement? So FSAs and HSAs, it's all about getting the reimbursements and showing the proof that you paid it. Okay, so you have to show proof that you paid it. So making sure that you have doctor receipts, daycare receipts, or whatever receipts that's out there. Okay, and there are some employers that are very strict on it, and they will check every single receipt to make sure that it's legitimate. Some employers don't even care. You just write them an email and they'll just reimburse you. Okay, so it just depends on the type of employer that you have.